Look at the global markets right now, and you will see a landscape paralyzed by fear. Stubborn inflation and escalating conflicts have investors on edge. Major financial institutions are sitting heavily in defensive positions. They are terrified of a looming recession, effectively keeping one foot out the door at all times to protect their capital. The most immediate trigger for this panic is the Middle East. Investors are terrified escalating tensions will disrupt global energy supply and send oil skyrocketing. All of this compounding anxiety over the last few years has built a massive psychological barrier. Wall Street calls this a wall of worry, a persistent pessimism that actually prevents normal market growth, and ironically sets the stage for a violent upward reaction. Strategist David Hunter argues the crowd has it backward. He believes we are entering the final chaotic climax of a 43-year secular bull market. This chart shows a normal growth trend, but notice the end. This blow-off top is a rare, violent trajectory where rational valuation is abandoned for pure euphoria. Hunter's targets are staggering, the S&P hitting 9,500 and the Dow reaching 65,000 before this cycle ends. To understand how numbers that large are mathematically possible, we must look past the stock tickers. The actual mechanics driving this move are hidden underneath in the global currency and bond markets. The first structural catalyst is the bond market, specifically a rapid and highly unexpected drop in the US 10-year Treasury yield, falling from over 4% down to 3%. The second catalyst is currency. We are looking at a significant weakening of the US dollar against foreign currencies, driven heavily by shifting interest rate differentials in places like Japan and Europe. There is also a strong political reality supporting this shift. Political leaders often implicitly favor a weaker dollar because it makes domestic manufacturing more competitive and helps balance global trade. While the dollar weakens, the widespread fears of highly expensive oil are likely misplaced. Temporary, war-driven price spikes naturally fade, and oil is positioned to drop back into the $60 range. Combine those three elements: cheap borrowing rates, a depreciating dollar, and contained energy costs. That specific combination creates the highly combustible macroeconomic fuel required to ignite a historic market melt-up. A weaker dollar acts as immediate rocket fuel for precious metals. This currency devaluation is what pushes physical gold towards an astonishing $6,800 an ounce. Silver is positioned for an even more aggressive trajectory. Hunter projects a violent and rapid climb, taking silver all the way up to $180 per ounce. This diagram shows exactly how institutional FOMO works. The absolute peak of this market represents the fragile edge of a very steep and dangerous precipice. Hunter warns that this euphoric melt-up will be immediately followed by a severe and devastating global bust, hitting late next year. The underlying rot that will trigger this bust is already accumulating. Deeply rooted, systemic issues are slowly building up in the private credit and private equity markets, and under the weight of the coming contraction, they will finally snap. The severity of this coming contraction will cause global demand to simply evaporate. As economic activity halts, oil prices are projected to plummet to $30 a barrel or even lower. This parabolic rise represents the final, desperate symptom of a dying economic cycle burning its last remaining drops of fuel. This chart shows the impossible psychological trap facing investors today. Selling defensively right now means missing out on 40 to 50% returns compressed into just a few short months. But there is a massive danger on the flip side. If you stay in the market to capture those massive gains, the sheer infectious euphoria of the peak will inevitably try to convince you that the good times are permanent. History proves that even the smart money is highly vulnerable to this trap. Highly sophisticated hedge funds have a notoriously terrible track record of accurately timing the top of a market cycle. When you are staring at the absolute top, the entire financial crowd will be aggressively screaming at you to hold. Executing a sell order in that environment is nearly impossible for the average retail investor. Surviving the blow-off top is the ultimate test of contrarian fortitude. It requires the immense bravery to lock in your profits and walk away, right at the exact moment the rest of the world goes completely mad.